All right, we're going to go ahead and get started because it looks like we have everybody in the class now. So we'll begin tonight's presentation. In case you missed it, my name is Jason Maida. I'm with American Pacific Mortgage. So I'm going to be your presenter this evening. And as I mentioned earlier, we're going to make this a very interactive presentation. So as I roll through tonight's content, we'll love to be able to interact with you, answer any questions that you have live. We get a chance to teach these workshops every quarter to our UCI alum, and really proud of our partnership with UC Irvine. I think we're on like maybe our 6th year. You may have seen us on campus. We've used to do this event in person. We also attend homecoming every year. So really love to be able to support our UCI community. So this class is going to run till about 7 o'clock tonight. Now, if it goes a little bit over, we'll stay as long as we need to go through Q&A with you. We want to make sure we answer all of the questions that you might have around homeownership. Just a little bit about me. So again, my name is Jason, and I work for an organization called American Pacific Mortgage. And so we're a partner, obviously, with UCI. We're a direct lender that provides financing tools. And we teach classes like this throughout the country. So we have various partnerships like UC Irvine with other schools, like USC or UVA. So various schools across the country that we help support in homeownership. Tonight's class is going to include information not only just in homeownership, but also on first-time homebuyer programs that can be resources for you when you're beginning to take that steps or that journey towards homeownership. Here's tonight's class talking points. So we're going to look a little bit at the housing market today, spend some time diving into the market values or values of homes or sales prices, talk about interest rates. Then we're going to kind of transition into budgeting. So if we were to think about looking at renting versus buying, what would that look like for us as prospective home buyers? We're also going to spend some time looking at credit. And so as we're trying to maybe optimize our credit score, what are some of the tools and maybe resources that can help get our credit into the best possible position? From there, we're going to look at various loan programs that are available to you as first, maybe even second or third time buyers as well too. And we also want to look at student loans and how those could potentially impact you from a qualifying perspective. We'll look at documentation that you'll need to put together if you decide to take those next steps in homeownership. We're also going to look at down payment assistance programs. We're going to look specifically at the state of California and some programs offered through California Housing Finance Agency, or better known as CalHFA. And then we'll wrap up tonight's class looking at the process. What does it look like to go through the different milestones of my pursuit of home buying? And then I want to talk to you a little bit about a consultation. So if I want to build a home buying plan to maybe start that journey towards homeownership, what's that going to look like? What would that entail for me as a prospective buyer? Okay, so let's go ahead and dive in. And the first place we always like to start our workshops is by talking a little bit about what does buying look like for me? Does it even make sense for me to purchase a home? Because all of us are super busy throughout our days. Probably the last place you want to be on a Wednesday night is joining a Zoom session talking about finances. But the reality is this is probably going to be one of the biggest purchases you make in your upcoming financial future. So, it makes sense that you're going to take some time out of your busy schedules to kind of learn a little bit more about what this could look like for you. So this is probably going to be one of the biggest investments. So when we think about that, like, what does that mean for us? Well, that investment creates better stability with our housing payment. So we're talking about affordability, the opportunity to create wealth. So as my home goes up in value, that value versus what I owe on the house creates equity, and that equity is potential wealth, right? This is an asset that you can pass along potentially to the heirs of your estate in the future. And there still is some really great tax benefits that come along with owning a home. And a lot of our clients don't realize that. So when we think about budgeting, it's not necessarily an apples to apples comparison. So that's why we like to dive in at the start of our sessions like this, is just to kind of talk a little bit about budgeting, because when we look at our prospective situations for our buyers, we want to make sure that we're going to put them in the best possible position, and budgeting comes along with that. So what I'm going to do is I'm going to share with you a budgeting tool. And in case you missed it earlier, all of our presentation material, including links to the website like this, is going to be all shared back with you tomorrow morning. So those of you that have signed up for our class, we have your email address, so we'll get that distributed to you tomorrow morning. So what you're seeing on screen right here is a rent versus buying calculator. And what this allows us to do a little bit of a side-by-side comparison. This is on the website for Freddie Mac. So when we think about Freddie Mac, that's for conventional loan purchases, and you're going to learn a little bit about loan programs in just a bit. Let's look at this budget analysis, and we're going to do some inputs here. We've kind of pre-filled some of the stuff out, but I want to kind of walk you through these different areas. So first of all, if we're thinking about our current situation, we're going to look at our renting, right? Now, some of us may be renting a room or living at home with family, and that's totally okay. So that'll kind of maybe change the budget calculator. But let's do kind of a what if scenario for tonight's discussion. So let's say we have $3,000 as our monthly rent. Now for renting, maybe we have renter's insurance. So let's assume that's $15 a month. We're going to assume that our rent is going to elevate about 5% every year. And then if we were to now transition to what our home purchase looks like, let's say we buy a house for $750,000. Now, you're going to learn later on in tonight's class that the minimum down payment for a $750,000 purchase is 3% of that price. So the minimum down payment is 3%. We're going to finance the difference. Property taxes are something we're going to have to think about when it comes to budgeting. Generally speaking, property taxes are 1.25% of your purchase price. We also have homeowners insurance. We have the maintenance costs of our home. And then under loan information, we're going to select a 30-year fixed mortgage. Now, we're going to learn about loan products and interest rates in just a bit. But for today's discussion, the interest rate we've inserted is 7.125. We have origination charges. So let's talk really quickly about origination charges. So origination charges are costs that you'll pay in using a lender's services. So every lender has those charges. They may just look different between the lenders that you decide to choose. Now, in working with our American Pacific Mortgage team, one of the cool things that we have with our UCI alum is that we reduced origination charges by $750. So that's a really great benefit that comes along with our partnership. Now, there's discount points that are available to you. If you decide as a buyer, maybe you want to look at bringing down your interest rate, because maybe at a 7.125% rate, maybe that payment's a little too high for us, but we want to bring down that payment. So you can elect to bring down that rate by paying points, and those are called discount points. Usually a discount point of 1 point equates to 1% of my loan amount, and then that 1% cost will bring down my rate generally about 0.25%. Okay, so that's what discount points look like. Other settlement services will include title, escrow services. Generally speaking, when we think about how we have to save for our home purchase, we want to save for our down payment. So in this scenario here, we got 3%, and then we have closing costs, which can generally be 2 to 3% of our sales price. And then finally, when we look at the last section, these are other assumptions. We're going to assume that our home will go up potentially 4% in annual appreciation. Now, some of the early forecasts we're getting for 2024 is that home prices could rise another 5%. So we're kind of even projecting under that for right now for this discussion. We're going to expect to be in the house for 7 years. We assume selling costs of my home. So we're going to now forecast out 7 years from now. If I was to sell my home, I would pay roughly about 10% in total costs between realtor commissions, closing costs to sell that home. Now, one of the cool things about being a buyer right now is I don't have to pay the commissions for a realtor that represents me for the purchase. Now, when I turn around and sell my home 7 years from now, for example, I will have to pay those commissions. But at least right now, that's not a cost that I have to endure. We have state and federal taxes. We also have a savings rate that we're going to calculate into the equation. And so what the calculator comes back and says, well, over 7 years, if I was to factor in tax benefits, appreciation, I'm going to have an opportunity of about $35,000 in real opportunity over 7 years. Now, that could be more, of course, if I have a lesser rent payment and as compared to what my new mortgage payment is going to be. That could also change if I'm, going to see a lower interest rate over time by maybe deciding to refinance my home. That could be the case. But when we look at the side-by-side comparison, that's why I encourage you to think about looking at all the benefits that come with owning a home. Because if I'm renting for $3,000 a month, now my mortgage payment is double that amount. So it's significantly higher. Now, if I can take on that new higher budget, I just need to know that I have all these other benefits like appreciation, tax benefits that need to be factored into my calculations. Okay. Now, everybody's situation is a little bit different. We understand that, but we just want to kind of provide the tools for you so you can better understand that when we go on this path towards homeownership, it's a comparison that we have to look at all the ingredients and benefits that come along with owning a home. Now, in case I didn't mention it earlier, with our Q&A tonight, if you do have questions, just throw those in the chat and then I'll go ahead and answer those for you live on air. Okay. All right, let's talk a little bit about the housing market. Now, we want to look specifically at the Irvine market. Now, because this is a partnership all across California with UC Irvine, I know many of you might be even joining us from the Bay Area or maybe in the Sacramento or Central Valley. But when we look at the chart for the Irvine Orange County market, honestly, it doesn't look a lot different than those other markets, because the challenges that we see in today's housing market is just a lack of inventory. Sellers are not necessarily willing to part with their 2.5% and 3% rate mortgages to put their homes on the market, because guess what? They're going to have to turn around and purchase another home at 6.5% or 7%, whatever their interest rate is at that time. So we have a challenge here in the market where there's just not as much supply, but demand is still relatively strong, believe it or not. I was speaking with a client earlier today, and their question was to me, well, Jason, with rates being at 7%, you probably don't have a lot of buyers that are active in the market. And actually, it's really not the case. There's a lot of buyers that are out there, because I think as a market, we just don't know where this can go from here, right? We're going to talk about interest rates in just a second, but there's buyers that are looking at their rent costs and saying, wow, do I really want to continue to pay $3,500 a month in rent when I can invest in ownership and be able to really control my own destiny from an affordability perspective? Now, let's look at this chart a little closer, and then we'll kind of talk a little bit about interest rates. So this obviously shows the median sales price quite higher than where most of our first-time buyers are going to be buying at. But I want to just kind of pay close attention to a few things. Number of homes sold, which is actually up a little bit from last year, down from when we had the previous year with lower rates. Median days on market, which is a little bit longer than, and that's kind of the challenge. We're at about 25 days on market for homes. So some homes that are sitting are just because they're less attractive to buyers. There still is a limited supply out there. So you have, high demand, limited supply. That's obviously stabilizing prices. And then in some cases, you can see here, we have prices ticking up just slightly. Now, what I said earlier is we have a projection of potentially a 5% increase in prices next year, even in this current interest rate environment. And let's talk about interest rates. And today, in case you guys pay close attention on what's going on in the economic markets, Federal Reserve Chairman Powell spoke today to talk a little bit more about monetary policy. The decision was made to pause on interest rate hikes today. That was honestly pretty expected in the market. But there was some, commentary on what monetary policy looks like going forward, especially for the balance of 2023. There was some hints that they could potentially raise rates again once or twice at going into the end of the year. So we're going to watch that really carefully, because, obviously another impact of increased rates could hurt mortgage interest rates. But the markets are still kind of digesting the information shared by Jerome Powell today. And so we'll see kind of where the markets go. Average interest rates right now are anywhere between 7.1 to 7.5. And that's reflected in the screen or the slide that we have up on screen right now. So I guess the question and it's important for us to understand as buyers, is like, how do we get to this place? Well, over the last year and a half, the Federal Reserve has been trying to combat inflation by raising the federal funds rate. And so we have seen rates hit 20-year highs. Because of that competitiveness or combativeness right now in the market with inflation. And the question is, have we reached the peak in interest rates? And I think a lot of us believe that we have reached that. I don't think we're going to see rates sail any higher, but I think it's a question of when are rates going to come down. And there's speculation that we'll see lower rates in 2024, but still a little bit of an unknown. And so as we're designing home buying plans for our clients, that's one of the things we're looking at, is where interest rates are at, based upon the timeline of when you want to buy, like what could interest rates potentially be. Now, one of the things we encourage clients to think about, especially if they're looking to buy in the next year, is that the loans that we're selecting today probably is not going to be the forever loan for us. And the reason why I say that is because interest rates, like home prices, will cycle at some point, and they'll cycle down. Now, is that a year from now, 2, 3 years? No, we don't really know at this point, but I share that with you guys because ultimately, if we purchase a home today, we hopefully will have the opportunity to refinance down to a lower rate that's at more kind of normalized levels. And that's something that obviously we want to kind of think about when it comes to home ownership. As we wrap up on the slide on interest rates, these different lines you can see here, we see the green line, which is representative of the 15-year fixed. You see the 30-year fixed closely side by side with that. Normally, a 15-year is going to run a little bit lower than a 30-year, but in today's market, we have what we call as an inverted yield curve. where short-term rates are intersecting long-term rates. So we don't really get that big benefit of a 15-year fixed product, even as much so with adjustable rate mortgage products too. Now, what goes into an interest rate? And I think, when I meet with clients, they may hear interest rates are this or that, or their neighbor received this interest rate. But interest rates differ for different clients and different products that you're selecting. And here's what goes into what makes up an interest rate. Well, first of all, it starts with credit eligibility. So if I have a 740 credit score versus a 680, that could change my interest rate offering, the type of product that I'm going to elect, maybe how much I'm going to finance, what I'm going to put for my down payment. So if I put 3% down versus 20% down, that's going to be a difference in interest rate. We talked a little bit about discount points where you have the opportunity to bring down your interest rate based upon the cost that you're going to invest into that loan. Again, just as a reminder, 1 point is equivalent to 1% of my loan amount, and then we equate that to total cash out of pocket. So if I have a $500,000 loan amount, 1 point or 1% would be $5,000. That means I would have to contribute another $5,000 in investment to potentially bring down my interest rate. Now, usually the rule of thumb is 1 point equates to a 0.25% reduction in interest rate. And finally, the term of your loan can influence your interest rate. So like I said, 30-year fixed versus a 15-year fixed doesn't make a huge difference now, but in normalized markets, we would see a little bit of a difference. And as we meet with clients to discuss their options, it's really, we're going to give you the guidance and figure out what's the right product fit for you. And that's one of the things we do as we meet with clients for consultations on a daily basis. Okay. All right. Any questions around interest rates or any of the topics we've covered so far? I want to make sure that I answer any questions if we have them from our audience at this point. Okay. All right. Again, feel free if you have any questions, go ahead and throw them in the chat. I'll go ahead and answer those as we roll through tonight's content. If I've had to back up a little bit, more than happy to do that. And we will carve out some time later on in tonight's class for Q&A at the end. All right, let's talk a little bit about credit. So when I think about first-time home buyers and maybe some of the challenges they have for buying, it's usually in two categories. It's going to be either assets, so lack of resources for down payment, which we're going to talk about that in just a bit. But it also could be credit. Now, that could be because I have student loans or I'm a little overextended, or maybe I've had some challenged credit. So what we like to do in our workshops is walk through credit, give you some tools and resources to better prepare you for home buying, and talk about how do we get to a certain credit score? Like what is made up in the credit model? So let's dive in and talk about the credit model now. So this is the FICO score calculation that you see on screen. So 15% of the credit score is how long I've had credit. So the longer, more mature my credit file is, the higher my credit score is going to be. 20% is going to be how much credit am I now trying to access? Those are also going to be new accounts that are opened, also new credit inquiries. Those are hard inquiries. So if I have a lender that's running my credit or I'm applying for multiple things, I'm probably going to have multiple inquiries. Those inquiries in the last 12 months are going to really impact that score by up to 20% in the weighting. 30% is going to be how much credit do I owe on my revolving credit accounts, my credit cards, my personal lines of credit. That's a 30% weighting. So utilization of credit is that's the second biggest item when it comes to credit scoring. So if you think about it this way, so if I have $10,000 in credit limits and I have $5,000 in credit balances, my credit utilization is at 50%. Now, if you're running closer to 70 or 80%, the rule of thumb is, or kind of my first step would be, let's do my best to try to get below 50% utilization. Now, if I feel like I'm pretty good there, I've kind of cut down on my spending and I can whittle down my credit cards more, the optimal level is less than 10% utilization. So that's what we want to kind of target for when it comes to managing our credit card or our overall revolving debt. Now, let me give you a quick tip on how to manage that debt. Now, when you go, if you want to kind of do a homework assignment tonight, if you were to look at your credit cards, pull out your most recent billing statement. And on that billing statement, there's a billing cycle end date, and there's also a due date. Well, the billing cycle date is when the credit card issuer sends out the data to the credit card companies, and that gets reported to the credit agencies. It gets reported to all three, TransUnion, Equifax, and Experian. And so if you've run a high balance up, or hopefully you haven't missed a payment, but let's say you missed a payment, that all gets reported out to the credit agencies. But what I would coach you guys to do is that if you look at that billing cycle date and your due date, if you can pay down or pay off those balances before the end of the cycle date, then you're going to give yourself a much more improved credit score, because now the agencies are receiving data that shows a much lower balance or an improved balance, basically, and hopefully payment history. So now you'll basically have a rise in your credit score, because a lot of consumers get in the habit of paying off their credit cards on the due date, and that's after everything is cycled out. So that kind of pushes your credit score lower than maybe what it should be. All right. So that's kind of a tip around utilization. And the last segment of the weighting is payment history, and that's 35%. And that's simply, how have I paid my bills? Have I paid them on time, or have I had some, kind of spotty credit history? Credit ratings for delinquencies are in 30-day delinquencies, 60-day delinquencies, and 90+ day delinquencies. So the more severe your delinquency, the bigger impact you're going to have to your credit score. Now, when we're looking at a credit score, if you've had some challenges and they're in the last 12 to 24 months, that's going to be the most impactful credit for your credit score. Now, every product that's offered by a lender has minimum credit scores. So as you can see on screen, FHA loans, a minimum of 580. You have your conventional loans at 620, VA loans at 620. And then we'll talk about first-time buyer programs for the state of California. Those usually have a minimum score of 640 for FHA loans, 680 for a conventional product. Okay, so as we design options for our clients, we're looking at qualifying from a credit perspective, but we're also looking at other components to the underwriting guidelines. A couple of the things I want to share with you around credit is around account closure. And why that's important is because we learned here earlier that length of credit plays a big role in the credit score. Well, if you close out an account, it actually pulls away all that account history from the credit scoring. So if I've had an account for 10 years and I decide to cancel that credit card, well, I just lost all that great history from the credit scoring. So really important, we don't want to jump to doing something like that, especially if we don't have a lot of other complementary accounts that currently report on our credit bureau. And when we look at credit scores as a lender, as you learned earlier, there's 3 different agencies that each provide a score. So TransUnion, Experian, Equifax. We take the middle credit score of all 3 agencies. Let me give you an example. So let's say my best score is 760, my middle score is 740, and my lowest score is 720. For qualifying purposes, we're going to take the 740 credit score for that particular client. Well, let's say we're going to add a co-borrower. So my partner is now going to join me on the application. Now, if my partner is 720 high score, 700 mid score, and my lowest score is 680, the 700 credit score is the lowest middle score between the two of us. So what we would have to do is take the 700 credit score for qualifying purposes. And as we go through different options for our clients, we'll kind of figure out what best product matches up with not only the credit score, but also the interest rate. Because as you learned earlier, that's going to also play a role in the offering for the interest rate. Here's a matrix that'll help you kind of learn a little bit more about how delinquent items or negative items in the past can impact your score and how long they're going to basically be with you. Okay. So hard inquiries, 2 years or less. Let me just point out something really quick. So when we start the process and do a consultation with our clients, we always do a soft credit check. And why that's important is because many of our clients that we're consulting with, maybe not buying right away. It might be a 2 or 3 year plan, right? So we don't want to put that impact into their credit score. So we always start with a soft score, just gives us visibility to the credit score, doesn't impact the score. And I think that's really important as we kind of assist our buyers on this path towards home ownership. Okay, let's talk about student loans. And student loans, are just a topic of conversation. I think probably if I was to look at 5 clients that I've worked with throughout the day, at least 4 or 5 of those have student loans that we have to have conversations with. And that's just part of financing and designing options for our clients. And so I think it's important when we talk about taking those steps towards homeownership that we get a better understanding of how we calculate the student loan payments. Now, I do understand student loans are going to be having a repayment beginning in October. And for our clients that do have those repayments scheduled, they've either already set up an income-based repayment amount or they're in the process of that, or they're just going to pay the standard payment that comes to them. Now, if you graduated during the pandemic, you have never made a payment on those student loans. So you're going to have your first payment start in October. Clients that have been paying prior to the pandemic, they already have a payment schedule set up. That's the payment that we can take for qualifying purposes. So I just want you guys to understand about how student loans work. So here's an example or how they work from a financing perspective. So if we had $75,000 in debt from a student loan standpoint, and I'm on an income-based repayment amount that, let's say, is $250 a month, I can use that payment for qualifying purposes. Now, if I've never set up a payment arrangement and I don't plan to, the default amount we use for a conventional loan is 1% of the aggregate balances. So that would be $750 for a conventional loan. For an FHA loan, it's 0.5%. So, we would be at more like $375 for monthly payments that we use for qualifying purposes. So it's important to understand that, because while, you're budgeting for a different number, if we have this supporting documentation, hopefully we can use the lowest possible number to help maximize purchasing power for our clients. Now, those loans right now are in forbearance. Now, if you're back in school, they'll usually put them into deferment. So even if you're back in school, we still have to count a minimum payment when it comes to qualifying purposes. Now, in some cases, we have parents that are maybe co-signed for the student loans and they're paying those payments for our clients. If we can show that a parent or a third party is making those payments, then we don't have to factor those in the qualifying, but we do have to demonstrate that we have 12 months of history of doing that. All right, let's talk a little bit about loan programs now. So what we like to do in our classes is share with you like 5 of the kind of core programs for financing. We'll spend a little bit more time kind of zeroing in on conventional loans and FHA loans, but let me give you kind of a high level of each one of these products. So first of all, when you think about a conventional loan, those are going to be Fannie Mae and Freddie Mac loans. So you can probably have heard that terminology out in the marketplace. A Fannie Mae and Freddie Mac conventional loan allows us to finance up to $726,200 with a minimum down payment of 3% for the buyer. Okay, so it's a 3% down payment, and the minimum credit score on a conventional loan is a 620 credit score. Now, some of our high cost of living markets, Irvine, Orange County area, LA County, they allow us to finance more than $726,200. They let us go up to $1,089,300. That's called a high balance loan limit. So anytime we finance more than $726,200, not only can we go up higher, but it's also going to require a slightly higher down payment. The down payment moves from 3% to 5% anytime we go beyond the conforming limits up to that higher amount. Okay, so that's on a conventional product, Fannie Mae, Freddie Mac loans. Now, the next product is FHA loans. Those are FHA loans, not just for first-time buyers. We have clients that are second-time buyers that utilize that product as well. That is a minimum down payment of 3.5% of the sales price. Now, that's a 3.5% down payment, regardless if you're at the conforming limit or if you go all the way up to the high balance limit. Just as a side note, those high balance limits will vary based upon where you're at in the state and across the country. So, some of our clients that we work with on the East Coast, they may be capped completely at $726,200 because maybe they're not in a high cost of living area, or maybe you're in the Midwest, for example. So just something to kind of think about. FHA loans are going to be for our clients that have at least a minimum credit score of 580. VA loans are going to be a no down payment option. Those are for our veterans that have served. Generally, the veteran's going to have a certificate of eligibility that says, what they're eligible for under the product, what their entitlement is, and if they're potentially eligible for a waiver of a funding fee. Generally, when you have at least a 10% disability from the VA, then they completely waive your funding fee. And so you may want to know what is a funding fee? Well, funding fee is a cost that the VA charges for that financing. For first-time users, it's generally about 2.3% of the loan amount, and that gets rolled into your amount of financing. Moving on over is the USDA product. That's you're guessing right. That's the United States Department of Agriculture. So USDA has products for more rural areas. So if we have clients that want to purchase in some of the surrounding areas, let's say you really wanted to buy a house in Joshua Tree, right? That would be a USDA eligible area. There's 2 components to USDA eligibility. It's income and it's location. The income looks at your household size and total income for the household, and they look at the geography of the location of the home. And so USDA will have a no down payment option for buyers that elect to purchase in those areas. And finally, jumbo loans. Those are going to be for clients that maybe need a little bit more financing because they're buying at maybe the $1.5 million or $1.6 million level. They need jumbo financing. Now, with jumbo financing, as opposed to maybe conventional or FHA, the down payment's a lot higher. It's anywhere between 10 to 15% down. There's also higher credit score requirements. Usually, it's a minimum of 680 for a jumbo loan. And with jumbo loans, they do require a reserves. And what reserves are, it's additional assets that I have once I've contributed my down payment as well as those closing costs. So if you guys remember from our budgeting scenario we went through, 2 to 3% of our sales price is what we're going to kind of factor in for closing costs. Well, not only do I need those components, my down payment, my closing costs, but I need reserves. Reserves are generally going to be 12 times the amount of monthly payment. So let's say I have a $7,000 mortgage payment, 12 months reserves means I need an additional $84,000 in assets left behind after I've contributed my down payment and closing costs. Okay. Not a lot of our first-time buyers are going to elect that program, but we always like to kind of talk about it just in case it does happen to come up as part of your plan for home purchasing. Okay, so we want to kind of now transition a little bit, and I want to kind of go a little further into talking about conventional and FHA products, but I want to look specifically at PMI, or that's also known as private mortgage insurance. So private mortgage insurance comes into play when I put less than 20% down to purchase my home. And so I want to share with you what makes up private mortgage insurance, because I think it's, especially around budgeting, really helpful to understand how PMI works and how it can impact my buying plan. So let's first of all look at conventional products. Now, in a conventional mortgage insurance scenario, we have different payment options. There's monthly MI, which obviously we're going to pay it on a monthly basis as part of our monthly payment. There's split MI, which I pay some of it up front and I pay some of it through my monthly payment. There's single premium, which I'm basically buying out the mortgage insurance, in essence, writing a check to buy out the mortgage insurance. And there's lender paid mortgage insurance. In that scenario, what I'm doing is I'm taking a slightly higher than market rate to use the proceeds of that rate to buy out my mortgage insurance, in essence. So if rates are at 7.1 today, maybe I take a 7.75 rate and buy out my mortgage insurance completely. That's probably the least popular option for most of our buyers. The most popular one is monthly mortgage insurance. And the reason for that is because monthly mortgage insurance has a potential cancellation option where once I have 22 years in my home and 22% equity, I can apply with my mortgage servicer to see if I can cancel my mortgage insurance. Now, you heard me talk a little bit about refinancing in the future, and that's something also that can help you alleviate mortgage insurance. So if my home goes up in value and maybe I reach 20% in equity, then I could refinance and get out of mortgage insurance. But the cool thing about conventional products is I don't necessarily have to do that in order to remove my mortgage insurance. Now, there's three kind of key components when it comes to what makes up mortgage insurance and the cost that I'm going to pay. It's based upon my down payment, what my credit score is, and then how much I'm going to finance. So many of you have already done searches maybe on Zillow or Redfin, and that's all great. Now, if you use their payment calculator tools, they're going to give you kind of an error or a much higher payment level because their calculator is not calibrated to those three components there. So we would encourage you to take a look at our APM mobile app. In fact, I'll share that with you a little bit later on tonight, because those are all calibrated based upon those components there. So conventional mortgage insurance has a cancellation option. And let's look at the cost of mortgage insurance, because I think that's where there's a big kind of an area of opportunity, or kind of an awakening for a lot of our buyers, because a lot of buyers think mortgage insurance is super expensive. And so if we looked at this scenario here at the bottom, we have a loan amount of $700,000, assumed credit score of 740, and I'm putting 3% down. Well, my mortgage insurance is $209 a month. Many of those calculators may show $400 or $500 a month, which just really isn't the case. Now, the higher I can get my credit score, the more I can increase that down payment, then I can bring down that mortgage insurance at a lower level, right? Now, FHA mortgage insurance looks a lot different. And when we compare these two products, FHA mortgage insurance, first of all, has two components to mortgage insurance. There's upfront mortgage insurance, which is 1.75% of my loan amount, and that gets added into my balance that I finance. And there's also monthly mortgage insurance, which is 0.55% of my amount, and then I divide that by 12, and I have a dollar amount on a monthly basis that I pay in my mortgage payment, okay? So it can be a little bit more expensive than conventional mortgage insurance, especially because conventional mortgage insurance does not have the upfront premium. Now, with FHA mortgage insurance, it cannot be canceled until I decide to refinance out of that product. So it doesn't have that benefit like conventional. So let's look at the calculation for FHA. So we take the same loan amount, $700,000. We have to add in an upfront mortgage insurance premium, which is 1.75 of the loan amount. So that's now $12,250 that I'm gonna have to increase my balance by. And then we have the monthly payment amount, which is $320.83. So that's 0.55% of the loan amount. So we step back for a second, we do a quick analysis. We understand that obviously mortgage insurance is higher, both from a monthly perspective, and I have the upfront with FHA. Now, I think it's important to understand that there's different qualifications under each one of those products. So while we all want to kind of gravitate towards the lower product with conventional, not all clients will qualify in conventional. And well, let's look at just the credit scores, right? FHA is a 580 minimum. Conventional is a 620 minimum. Now, conventional is going to be a little bit more kind of focused in on what does credit history look like, especially in the last 12 to 24 months. So if I've had a late payment, maybe on a credit card because I missed the balance or the payment date, that might be acceptable for FHA, but conventional might not give us that flexibility. Whereas if I also had a bankruptcy that, let's say, was 2 years ago, FHA would be okay with that, conventional not so much. And so it's really important for us to kind of help guide you through the guidelines and see what product is best. And so, those are things we have to factor into our home buying plans that we create for our clients. All right, let's talk about documentation when it comes to home buying. So we're going to go through kind of an income section and some of the documents generally that you would need as you start this path towards home ownership. So for our W-2 employees, it's pretty simple. We're going to generally need the last 2 years of W-2s, the most recent 30 days of pay stubs, and then we're generally going to do a verification of employment. That verification comes in various forms. It's going to be a verbal verification and some type of written verification. For some of our self-employed individuals, it's a little bit more document intensive. We have to get the last 2 years of taxes. And by the way, any of our self-employed individuals, they have to be in business at least 2 years. We're going to need a P&L statement, usually a balance sheet as well. And then we have to verify the validity of the business. So whether that's a website, that's through a business license, things like that, maybe even CPA letter, those things will all help us validate the business. Okay, so those are documents generally needed. Now let's talk about some scenarios. And I think there's a little bit of a misconception out there, especially when it comes to work history for future buyers. A lot of clients believe that they have to have 2 years on the job before they can apply for a mortgage. So that's actually not the rule. So the way the rule works is you have to have at least 2 years of work history and or supporting education. So here's an example that I use all the time. Let's say I graduated in the fall from UCI. I got my accounting degree, but I spent 4 years at UCI. I just got hired on an accounting firm this spring, right? And I'm still new on the job. I'm less than 6 months. But because I have my employment or educational history combined with my work history, I meet the 2-year requirement for eligibility. Okay, so that's one way of getting there. Now, even if I've maybe started a new job, but I have 2 years work history from my prior job, that would also qualify for the two-year work history rule. So I think it's important for you to understand that because some buyers I've talked with in the past have kind of just waited on the sidelines because they thought they needed that 2-year requirement to be met. Now, if you have dual employment, and we see this a lot in the healthcare industry. So let's say I'm working for one employer for 30 hours a week, another employer for 20 hours a week, so a total of 50 hours. I do have to show that I've been working with both employers simultaneously for 2 years because we do have to be able to show that you've demonstrated the ability to be able to work 2 jobs at once. So that's where that 2-year requirement would be a little bit different. Now, if I'm working a 40-hour work week job, but I also drive for Uber on the weekends, if I want to include my Uber income, I have to demonstrate that I basically had my W-2 job, my 40-hour work week job for 2 years, and I've been able to sustain or maintain my job with Uber for 2 years simultaneously. One other question that comes up for some of our buyers is if I want to apply in just my name, but I do have other income, whether that's from a partner or maybe from a room rental, whatever the case may be, only income that's included through myself. So if through the applicant is income that can be factored into qualifying purposes. So if my partner is not going to join the application, then that income can't be factored into the eligibility. On room rentals, that really can't. There's some products that will allow that to be used. For most products, we can't use existing room rentals because there can't be an assumption that that tenant is going to carry over to the next property you decide to purchase. Okay, we're going to stay with income for our last component here, or last kind of talking point around income. And we're going to now kind of talk about qualifying under income. There's a thing called debt to income ratio. And what debt to income ratio does is it looks at your gross monthly income versus your monthly expenses. And so we're taking in consideration things like credit card debt, student loans. We're going to look at maybe personal loans and the expected housing payment that you're going to have with your new house. And this calculus that we use is a pre-tax calculus, but it doesn't necessarily look at affordability. It's just a qualifying metric, right? So one of the things that we have to think about as we're working together to design your home buying plan is we're looking at affordability, and that's a conversation that we're going to have as part of your one-on-one consultation, because that's the most important thing. There's two big goals for us with homeownership for our clients. One is affordability, and it's also sustainability, right? We want to make sure over a long period of time that this is a home that we can grow into, and it's something that's going to feel comfortable for years and years to come. Okay. Before I kind of go into the formula, let me just answer a question that came in, because we're going to backtrack to work history. So the question is, how far back can you use your two-year work eligibility? So we can go back several years. I mean, if there's job gaps, we have to explain them. Especially during COVID, a lot of our clients had job gaps just because of just the labor markets. But if you were out of work for 6 months and now you've regained employment, as long as we can kind of track that history, that shouldn't be an issue. All right, good question. All right, here's the formula for debt to income ratio. So I mentioned it earlier: principal, interest, taxes, insurance. So that's your housing payment. And if I decide to put less than 20% down, I have PMI. If I buy maybe a condo or a townhouse, some of our residential areas have what we call as HOA fees, homeowners association dues. So if in my example here, if I have $2,500 a month in housing expense, my other debts are $500 a month. So then when I think about my debt to income ratio, I have $3,000 expenses divided by my monthly income of $8,500. That means 35.29% of my income is consumed by my obligations. Now, typically the maximum debt to income ratio is about 45%. On exception, we can go to 50%. It's really going to be, the tolerance level is going to look different for every client, right? The question I do get is, where do we think we should have our debt to income ratio at? And that really just depends for every buyer. Most of our clients feel pretty good when that debt to income ratio is around 33 to 36%. All right. Okay, so now we've kind of wrapped up the income section. Now I want to spend some time talking about the last component to home ownership, and that's assets. And that's one of my kind of two challenges for most of our buyers is credit, or it could be just resources for down payment. So let's talk about what that might look like from a documentation perspective. So if we've been able to save and we're ready to purchase, the typical documentation would be the last 2 months of bank statements. If we're going to use things like 401ks, 403bs, maybe even an IRA account, we'll want to see the last 2 statements of those accounts. Now, I would encourage you to talk to your financial advisor, maybe your tax advisor, make sure you're not creating a tax event by accessing those funds, because that could be something that kind of impacts you down the road. Now, let me just kind of jump back to checking and savings accounts. If you have cash deposits, those can't be used in financing transactions. So when you're buying a house, we do have to paper trail all funds that come into your account. Now, you may receive money from Zelle, or you may have some Venmo or something like that. If we can paper trail the source of that, and it's a valid source, then we could potentially use those assets. But we're really looking at the last 60 days of assets, especially in your transaction histories. Now, at times, you're going to have family members that want to say, hey, Jason, I want to help you purchase your home. And those are called gifts. Gift funds are absolutely eligible. In fact, I met with a clients this afternoon that are getting gifts of up to 20% of their purchase price. And that's absolutely can be used. There's a way that, can we go logistically through that to help facilitate the gift funds. But normally the donor would complete a gift letter, indicate how much they're gifting, who the recipients of the gift are, and then they'll transfer those funds to the escrow company. At times, we'll need to verify that the donor has those funds, but not all products require the sourcing of those assets. Okay, and those are called gift funds. So not all of our clients have, maybe adequate savings to be able to start that path towards homeownership. Believe it or not, most of our first-time buyers have anywhere between $8,000 to $12,000 in total assets available, and at times that creates a burden of the timeline for buying, right? So most of our clients are projecting 3 or 4 years out, but there's resources out there like first-time buyer programs, especially in the state of California, that can maybe make that buying timeline a little bit more of a near-term goal for you. So I want to spend some time talking about CalHFA, and that's the California Housing Finance Agency. And what CalHFA does is it helps support low to moderate income households achieve home ownership. And we understand the cost of housing is at all-time highs in California. So it doesn't make a difference if you're renting or buying a house. Housing is expensive. Things are expensive in California, right? And so these resources can help solve one of those components to homeownership, and that's the assets. So let's talk about those products. So MyHome is a product that provides support of up to 3% for a conventional loan. So it's 3% of your sales price for a conventional loan, 3.5% for an FHA loan. And what it is, it's a low interest rate loan offered at 1% simple interest. So just for that amount of money that can count towards your down payment and closing costs. Even better, those assistance funds do not need to be paid back to the state until you either decide to sell the home or if you refinance in the future. Okay, so that can help fill the minimum down payment requirements for an FHA conventional loan. Even works with the USDA and VA product, even though those don't have minimum down payment requirements. Now, there's also closing costs when we purchase a home, and the ZIP assistance program can help with that. You can generally get 2 to 3% in zero interest assistance to help towards closing costs through the ZIP assistance program. Now, in today's market, with interest rates being a bit higher, the ZIP assistance doesn't necessarily make a lot of sense because it can elevate your first mortgage rate from, say, 7.1 all the way up to as high as 8% in today's market. So we would encourage our clients, if you can save up enough for closing costs, that probably makes the most sense, so we can get the lowest available interest rate for that first mortgage. Now, some of our attendees in tonight's class may have heard about another product through CalHFA called the California Dream for All program. That's got a lot of notoriety. It's been in some of the news networks and different publications. That California Dream for All program had a phase 1 earlier this year where $300 million was allocated from the state for first-time home ownership. Well, we blew through those funds in 10 days, helped 2,300 families achieve home ownership. So that was successful, but there's another phase 2 of funding. There's been some miscommunication around that product out there in the marketplace. That product's probably not going to be available sometime until 2024. We're currently revamping guidelines for that and waiting for some guidance from state legislators, but stay tuned for that program. We'll be announcing more information as we receive that from our CalHFA partners. Okay, before I kind of move into some scenarios with first-time buyer assistance, I want to answer some questions online. So first question came in: if I have accounts with multiple banks, do I have to show them all? So you don't necessarily have to. Usually we would just ask for the accounts that you plan on contributing towards your down payment and closing costs. We'll want to verify those. At times we may need to get verification for reserves, but you don't necessarily have to show all of your accounts. So a question came in of how about Landed? It's a program for California public or CSU employees. I'm not familiar with Landed, so I mean, we can take that question off air. I can do some research. There at times, if it's a CSU program, that might be something that's offered to professors or staff faculty that's transferring to a CSU campus. But if you want to, we can kind of connect more offline and talk more about that. And then, so another question on CalHFA is, can you combine these programs? And so you absolutely can. Just to my point earlier, like, I don't know if it necessarily makes sense to add the ZIP assistance in today's market. So I would encourage clients, if we can somehow save enough money for the closing costs or get support from family for gift funds, that could be a route that we could go. All right. Okay, another question came in. If I'm eligible for both FHA and conventional loans, which one could be a better tax benefit? So tax benefits will really be something you want to have answered by a tax professional like an advisor or a CPA. Interest rates will play a role in tax deductibility. So that's why I would encourage you to talk to a tax advisor on something like that. And then the next question was, what do you think about a lease to own option? And those options do come about in today's market. And so it really just depends on the terms of that. If you're securing what price you're securing, because what you're doing is you're agreeing to a option price at a certain level so you can buy in the future. So not necessarily a bad thing. I think you have to make sure you feel like you're getting a fair deal for a future price that's going to be available to you for that home. All right, so let's talk about or look at an example for the CalHFA assistance program. So let's first of all look at just a basic sales price of 700,000, along with a minimum down payment of 3%, and assuming closing costs of about 2 to 3% of your sales price. So in a traditional sense, I would need to have at least $35,000 to $42,000 saved for my home purchase, just with the minimum down payment. Now, we understand that that might be a stretch for most of our first-time buyers. So to my point earlier, that may cause our buyers to have to look 3 and 4 years out, and that could work too. But with a first-time buyer assistance program, if we incorporated the 3% My Home assistance, now we can solve for that down payment. And so in this scenario now, maybe that closing cost of say 14 to 21,000 can be facilitated through our buyers' funds, or like I said, through gift funds. If that isn't an option, then of course we've talked about the ZIP assistance program that can help fill the void of 2 to 3% of the loan amount towards closing costs. So those are different ways that we can help bring down that total amount of money out of pocket and then make homeownership that much more of maybe more of a near-term goal for a lot of our clients. You know, we're proud to be the #1 provider of CalHFA assistance in the state. I'm really passionate about this product because, you know, we want to create affordability and sustainability across our communities that we serve, especially in California. And so the eligibility on this program has some requirements, but they are very lenient as it relates to first-time buyer resources. So there's a minimum credit score of 640 for an FHA loan, 680 for the conventional product. And a first-time buyer is actually someone that hasn't owned in the last 3 years. So I've at times had clients that have purchased in the past, have sold, you know, maybe 4 or 5 years ago. Well, guess what? They're still now first-time home buyers again. As it relates to the debt to income ratio, it's generally a 45% maximum debt to income ratio. At times, we can go to 50%. And one of the good things about CalHFA, among all the great benefits, is that the income qualifying is only based upon the applicant income. So many first-time buyer programs look at the total household income, but we only look at the applicant income. And why that's important is because on the income limits, if our household size income exceeds the income limits, if I just look at my applicant income, that could potentially keep me in range for qualifying purposes. I'll share the income limits with you in just a second for Southern California. And this is eligible for single family homes, you know, new construction, condos, townhouses, BMR homes. In case you don't know what BMR, that's a below market home. So that's completely eligible there. Even manufactured homes can fall under the qualifying for CalHFA. So question popped in is, does the definition of first-time homebuyer change at the California state level or federal level? There is no federal level products out there, so it's hard to say. If, you know, if the federal government introduces a first-time buyer product, then maybe that could change. But from a state level perspective, the guidance is 3 years as someone that has not owned a primary residence in the last 3 years. So conceivably, you could own a rental property on the East Coast and be renting in California for 3 years. You're still considered a first-time buyer as long as you've rented for the last 3 years. Okay, here's the income limits for the CalHFA program. So we spotlighted our Southern California markets, as you can see on screen. These are all about 150% above the median income for those markets. Now, if you might be joining us from Sacramento or San Francisco Bay Area markets, those income limits look a little bit different. We'll send you along the link to the CalHFA website where you can see all the different income limits based upon by county. But one of the cool things about CalHFA is it's the leniency of the program. So the income limits are far higher than what you'll see with most first-time buyer products, which are generally 80% or below the median. I'm sorry, below 80% of the median income for whatever community you're trying to buy in. But these are at 150%. All right. So I think we've answered most of our questions. And so kind of staying on track with tonight's class, let's talk about the 6 steps of home buying. So now you've learned a little bit about products and credit, assistance programs, and some of the documentation required. Well, let's see what this path looks like towards home ownership. So this is our 6 steps of home buying. Now, step 1 is going to be the output of a one-on-one consultation with me. So that's where we get a chance to do a video session together to design a home buying plan. The output will be what we call as a pre-approval. So a pre-approval shows your eligibility for whatever financing we put together for you. And you can take that pre-approval certificate to give to a seller when you decide to make an offer on a home. Now, that pre-approval is generally good for 60 days, but we can always recertify it. In fact, just before tonight's class, I was talking to one of your fellow UCI alum. She's been shopping for homes for the last 3 years and just hasn't found anything, but we just recertified her pre-approval this evening. We can do the same thing for you. So we don't want you to feel like there's any pressure to buy right away. So whether it takes you 2 months or 2 years, we're here to help support you in that process. So house hunting is step 2. So that's where you get a chance to maybe go from online searches to now maybe looking at more in-person properties, right? We would encourage you to connect with a realtor. As you heard earlier, realtors are paid for by the seller. We also have a fantastic network of preferred realtors across the communities that we support. So we can always get you connected with a realtor at some point during your home search. Now, step 3 is going to be after we found a house and the seller accepts our offer. Now we move to step 3. That's a pretty exciting time because that's kind of half the battle is just getting an accepted offer in today's market. Now, step 3 now will start forward the lending process from a different perspective, because now we're in the escrow time period. The escrow time period, so from acceptance of offer to getting the keys, is traditionally 30 days. Now, we've made some enhancements to our process to give our buyers really an edge in today's market. In fact, we have closing times as short as 14 days to be as competitive as possible in today's kind of challenging market. But traditionally, it's 30 days for the close of escrow time period. Now, what does it mean when we've gone into escrow? Well, we know we've got an offer accepted. Now the financing will kind of kickstart, and we'll reach out to you to kind of talk about some of the next steps, which will include setting up a follow-up consultation to review your financing, today's market interest rates, what your out-of-pocket looks like, revisit the product you've chosen. Just make sure you feel comfortable with the financing. We're also going to start issuing disclosures to you, ordering your appraisal of your property, because we want to make sure your house is worth what you're paying for. And then, in the first 2 to 3 days, you're going to be required to make what we call is an earnest money deposit. And that deposit is usually 1 to 2% of our sales price that will count towards our total out-of-pocket expense. Now, one of the key components to a contract in California is the contingency period. A contingency allows you to do your homework on the property, which will include getting the house appraised, which I mentioned earlier. So we'll start that. We'll also get your loan approved, and then your realtors will generally help orchestrate and organize inspections of the home. Now, the contingency period is traditionally up to 17 days per the contract, but going back to today's market, it's a little bit more competitive. So at times we have to shrink those down to like 7 days to make sure the sellers feel a little bit more encouraged to accept your offer. But that will vary based upon market conditions. But traditionally, that contingency period is 17 days. So that contingency will probably take us, if we look at this slide, from step 3 all the way to step 5. So let's talk about step 4, though. That's processing and underwriting of the loan. That's the administrative task. We do things like verify your employment, verify assets, get documentation together, hopefully have your interest rate locked by that time based upon market conditions. And then we'll submit everything to an underwriter who reviews all those items in your file. And that loan approval is issued usually within 7 days of the accepted contract. Sometimes it's a little bit shorter just because of timelines that we have to meet per the contract. But the underwriter issues that approval. That also is going to almost push us to like 3/4 of the way through the process at times. And once we reach step 5, you're going to probably be at the end of your contingency period. So if you've done all your investigative work, you feel good about the property still, then you'll sign off on that contingency. And that tells the seller that you're okay to go to step 6 in the process. Now, we want to be mindful that once we sign off on that contingency, it also pushes that earnest money deposit into the transaction. And what I mean by that is if you decide to cancel after that point of sign off, you could risk losing your deposit. So we want to make sure that we feel comfortable with everything before completing that sign off. And finally, at step 5, we're going to issue to you a final closing disclosure. And that closing disclosure gives you a 3-day cooling off period before you do your in-person signing at step 6. And that's called closing your loan. So there's a few things that happens in step 6. You're going to be signing final documents in person with the notary. Everything before that, all those milestones, those disclosures can be signed via e-signature. You're also going to wire in your final funds for closing. As a lender, we're going to audit your loan just to make sure all the documents have been signed correctly. Then we're going to wire in the funds for both the first mortgage, and if you've elected maybe any assistance programs, we'll also wire in those funds. Those monies get receipted in by the escrow team, and they balance everything out to ensure you've contributed what you're supposed to as a buyer, and the seller's receiving the proceeds that they expected. And so after that's all completed, the documents get recorded with the county recorder's office, and they'll record a grant deed. What a grant deed does is it transfers ownership to you. Then they also record a deed of trust, which is your agreement to repay the loan. And once we get confirmation back of those recordable documents, then guess what? We get to make the call to you and say, you did it. Now you're a homeowner. And, that's the most enjoyable part of my day by far. I mean, obviously I love teaching classes every week, but making a call to a client to say, hey, we did it. And, it's a big celebration, right? It's going to be the biggest investment we make in our financial future. So we want to be there celebrating with you. One of the things we love to do is after you've closed escrow on your home, within a couple of days, you get your housewarming gift to celebrate. And we love seeing all the pictures that are shared with us and all the testimonials we get after the closing of escrow. It's because it's a big deal. We want to celebrate right along with you. Now, if you're thinking about home ownership as a goal for yourself and want to, kind of see what a home buying plan might look like for you, or maybe after tonight's class, you have some questions, like maybe a follow-up question about some of the assistance programs, we can set up an introductory call for you. It's a 10 to 15-minute session where we just kind of answer some questions. Or if you want to build a home buying plan, we'd love to get started with you in that journey. So what get started means is we complete an online application. We usually upload some documents as a buyer, and then we get connected for a video consultation. You can see kind of all the steps here outlined on the slide here. But one of the cool things about our consultation is that not only is it a time for us to get a chance to know you a little bit more and design financing options for you, but it gets you a game plan, right? Get some goals and objectives for home ownership. And with the credit, which that tends to be a little bit of a concern for most of our clients, it's a soft credit check, so you don't have to worry about any impact. And it's a free consultation. Here's what the framework of a consultation looks like. Very similar to what we've talked about in tonight's class: budgeting, process. We're going to talk about product. We're going to talk about assistance programs, all the key ingredients you need to be successful in home ownership. I mentioned to you one of our resources is the mobile app. Has a great calculator function, but it does more than that. It'll kind of push milestone notifications to you. You can, submit your application right from mobile. Has some terms that you can kind of check in, like what does this mean? What does APR mean? Annual percentage rate, things like that. That'll help you as another resource for you. And you've heard about our discount with UCI, and we're really proud of our partnership and the multi-year partnership we have with UCI. But we have other partnerships, like I mentioned, across the country. We try to implement a very similar discount, or we discount originations by $750. Really want to provide that benefit to our partnerships that we serve all across our communities in the country. And so if you have friends, family, even some coworkers that maybe are part of those partnerships, we'd love to have them get connected with us. We teach these classes once a week for various partnerships that we serve across our communities. So they're always open to the public. So if you want to kind of get a sense of what's on our calendar for the rest of the year, you can check that out at mortgageeducate.com. And here's all my contact information. So I know we're wrapping up tonight's class, but I want to make sure you have all my contact info. And as I mentioned, we have some fantastic testimonials from our clients. I would encourage you to check out some of our reviews on Google. That's important because it's not just about us talking about this in our home buyer classes, but what's the experience been like for our clients. And on our social platforms, we'd love to share good content for you in this journey for home ownership. So as it relates to first-time buyer resources, you'll see a lot of posts related to that. So I would encourage you, if you can, follow us at JMeda Mortgage on Instagram as well for more information and details. And like I said, if you want to get connected with us, feel free to use our scheduler here. We have the link posted up in the slides. So we're kind of getting to the end of tonight's class. We're just over the top of the hour, so I appreciate everyone hanging in there with me. I do have some questions that came in, and I'll answer more questions live, and we'll stay online here for a bit longer to answer those questions. Let me dive into the first question here. And the first one is, the mortgage rates are higher now, but if we want to consider refinance options later when the rates are lower, how does one get qualified for a refinance, and how does a refi generally work? So the answer to your question, yes. Interest rates are higher right now, but I don't think, in how we're coaching clients right now, is this isn't going to probably be the forever loan for our clients. So even if we're getting into the market at 7% interest rates, hopefully we're getting into a market at a reasonable purchase price. So I'm more concerned about what the purchase price is versus maybe the interest rates, because hopefully it's something we're only keeping for the next 2 or 3 years. Now, if we do pursue a refinance, what a refinance means is I'm now taking and moving into a different loan. Why I would want to do that is because if my interest rates come down, that means I'm going to save money a month. But refinancing is not a free option for you. Refinancing generally will cost $3,000 to $3,500. So one of the things that we do in coaching clients on refinance is we want to make sure there's a good break-even point. Generally, we want your break-even point to at least be 18 months or less. So the rule of thumb would be is I probably want to save at least maybe $200 a month in refinancing with that lower interest rate. And refinancing usually takes about 20 to 30 days. Obviously, in today's market, we're not doing a lot of it. I'm sure that'll change as the market cycle at some point. And your discounts that we talked about through our UCI partnership still hold true with refinancing. So it's not just a home purchase type of situation. All right. Any other questions from our audience? Okay, I think we got it. All right. Well, I appreciate everyone joining us on this Wednesday night. Hopefully the information you found helpful. Hopefully there's one or two things you could take away on your path to home ownership. And we hopefully we'll get a chance to get connected with you to build your own home buying plan. Thanks again for joining tonight, and we'll get connected with you soon. Good night.